Hello everyone and welcome to this session on the creditor cycle in accounting. In this video, we will be looking at how trade payables move through the accounting system, starting from when they are first recorded, then how they are managed while outstanding, and finally how they are settled through payment. Let's start with the definition. So the creditor cycle deals with the way a business handles amount payable to suppliers. It covers activities such as identifying purchases made on credit, recording invoices received from suppliers, keeping track of unpaid balances, and eventually making payment. This cycle matters because it helps ensure that amounts owed are recorded correctly. It also supports cash flow planning and reduces the risk of expenses being recorded too high or too low. For example, when goods are received on credit and a payable of 15,000 dirham is recorded, that amount represents a liability that must be managed properly. So the creditor cycle begins once goods or services have been received by the business. It is concerned with the accounting treatment rather than decisions about choosing suppliers. The focus areas of creditor cycle include accounts payable, correct timing of recording known as cutoff, accuracy of invoices, and control over payments. Because of these areas, the creditor cycle is especially important for financial reporting and audit purposes. Now, steps in the creditor cycle. The creditor cycle follows a series of defined steps. Each step relies on documentation and internal controls to support accuracy. When these steps are carried out properly, they contribute to reliable financial statements. We will discuss each step one by one in the next slides. So the first step is recognizing a purchase made on credit. At this point, the business has received goods or services and an obligation to pay the supplier exists. This obligation is recorded even if the invoice has not yet been received. This approach follows the accrual accounting principle and helps avoid understating expenses and payables. So for example, if goods worth 12,000 dirham are received but the invoice is still pending, the expense and the related payable are recorded at this stage. As you can see, the expenses are debited with the 12,000 amount and liability payables has been credited with 12,000 amount. So the next step occurs when the supplier invoice is received. The details on the invoice are checked to ensure accuracy, including quantities, price, and tax amounts. This process confirms the final amount that needs to be paid and ensures that only valid invoices are recorded. For instance, an invoice of 12,000 dirham with VAT at 5% results in VAT of 600 dirham, making the total payable 12,600. So the general entry here would be of accrued expenses debit 12,000, VAT input debit 600, and accounts payable amount will be credited by 12,600. Once the invoice has been verified, it is recorded in the accounts payable system. The supplier's account is updated, payment terms are noted, and the due date is recorded. This keeps the payable ledger up to date and provides a clear audit trail. So in this example, the supplier balance becomes 12,600 dirham, which is payable within 30 days. At the same time, the liability increases and VAT recoverable is recognized. After recording, payables need to be monitored. Outstanding balances are reviewed and grouped based on how long they have been unpaid, such as uh, like from 0 to 30 days and from 31 to 60 days. This helps the business manage cash flow and identify overdue or disputed amounts. Since this step is a review activity, so no general entry is required. Before payment is made, invoices and related documents are reviewed. Approval is provided by authorized personnel and the payment is scheduled accordingly. This step helps prevent unauthorized or duplicate payments and ensures accuracy. Because this is an approval process, so no accounting entry is needed. In this step, the payment is made to the supplier. The step name is settlement of creditor balance. So once the payment is processed, the accounts payable balance is cleared. So for example, a bank transfer of 12,600 dirham reduces accounts payable, it is debited, and decreases the bank balance. That was all for the steps in the creditor cycle. Now here we are looking at how the creditor cycle affects the financial statements. Starting with the statement of financial position, accounts payable appear as liability once they are recognized, and when the payment is eventually made, cash is reduced as the liability is settled. Moving to the statement of profit or loss, expenses are recorded when they are incurred, not when payment is made. So this ensures expenses are matched to the correct accounting period. So to connect this with an example, if payable increases by 12,000 dirham, that amount appears as a liability, and once the payment is made, cash decreases by the same amount of 12,600 dirham. Okay, now internal controls, they play a key role in managing the creditor cycle. One important control is approving invoices before they are posted into the system. Another is segregation of duties, where recording transactions and releasing payments are handled by different individuals. Regular review of payables aging helps identify overdue balances, and supplier statement reconciliations ensure that recorded balances agree with supplier records. So for example, the person who records an invoice should not have the authority to release the payment. This separation reduces the risk of errors and misuse of funds. Okay, so if the creditor cycle is not properly controlled, several risks can arise. Liabilities may be missed entirely, invoices could be recorded more than once, VAT may be treated incorrectly, or payments may be delayed or made without authorization. So to illustrate this, consider an invoice of 5,000 dirham that is not recorded. So as a result, what would happen? Liabilities would be understated and the financial statements would not reflect the true obligation. Let's also discuss some audit perspective. So from an audit perspective, the creditor cycle receives significant attention. Auditors focus on whether accounts payable are complete, whether transactions are recorded in the correct period, and whether invoices are recorded accurately. To address these areas, auditors perform procedures such as obtaining supplier confirmations. They also review payments made after the reporting date and perform reconciliations of payables balances. And these procedures help auditors gain assurance that liabilities are fairly stated. Okay, so to conclude, the creditor cycle is focused on managing liabilities rather than procurement activities. It ensures that payables and expenses are recorded accurately and in the correct period. Strong internal controls help protect cash balances and support reliable financial statements. And because of its impact on liabilities, expenses, and cash, the creditor cycle is a critical area for audits and compliance. So that brings us to the end of this session on the creditor cycle. Thank you for your time and attention. I hope this discussion has helped you better understand how trade payables are recorded, managed, and settled. Thank you once again and see you in the next session. Bye.